Hello, everyone. Good afternoon or good evening to you guys. It is Wednesday and it was a bank holiday, so I hope that no one was trading right as I asked you guys to not do. But I know some of you guys still ended up doing that anyways. So for Monday, we actually got, so far in the week, we got exactly what we were looking for, right? We expected movements on Monday. If you guys remember, if you listened to all of the stream, if you didn't, then you should go back and listen to it, right? This would be, more eye-opening if you watched the last stream, even though it was long. Tuesday, what did we expect? We didn't expect much, yesterday due to the fact that it's before a bank holiday. And as you guys remember, you can, remember me stating that, before bank holidays, we usually have, choppy and lackluster price action. On Wednesday, it's a bank holiday. Today we have little to no volatility. And tomorrow, Thursday, and then, Friday is when we will expect volatility to enter the marketplace. So with that being said, we're going to be looking at this chart right here. As you guys can see right now, and this is just to, allow you guys to understand that what we, do here is, it's second to none, and there's literally nothing else out there that can give you the accuracy, that these concepts give you. If you look, you can see that the dollar index is, consolidating. You can see that and this is the daily time frame. You can see that the euro is consolidating and the Great British Pound is, consolidating as well, but like in a slightly, upward trend. Here, would be considered as, low probability conditions. But, to us, the only time price is low probability, and, this is something important as well. I'm saying, I'm not just saying it to say it. The only time when price is low probability is when there's not sequential SMT. So if you guys remember, right, we did cover this, move right here. And we spoke about what we expected of price action. Also, as you guys know, right, if I'm not, sure about something, or, sometimes I will be sure about, 2 or 3 moves, but I will give you one due to the fact that I need you to focus on that one, right? Because it has more elements which makes a setup high probability, right? So first of all, you should understand, right? You see this that you're looking at right here, which is the monthly cycle. It's one of the most influential cycles out of all of them. And this is due to the fact that, of course it's time-based, but, for some reasons, the banks prefer, this cycle, which is the monthly cycle. This cycle will, give the, most of the, trading weeks, even the trading days, the most influence due to the fact of its, reoccurring nature. So out of, most of the cycles, the monthly cycle and the weekly cycle, will occur the most, in regards to their cycle, not like in regards to time, because obviously lower time frame cycles will, occur more than that, but these will have more influence due to the fact that they are, higher time frame. Here, you can see that, right, we have liquidity below this low, and now we're looking at the euro. So currently, is there something to do? No, there's not, right? And why is this? What makes this quarter more low probability in the, the FX triad than it would be in the index futures triad. This is due to the fact that we already had the move here. You see, it's not really high probability to have two consistent sequential SMTs in a cycle. Did you get that? So there will be times when you would have, for example, a sequential SMT form on Monday, right? Which sends price either lower or higher, just causes manipulation and then distribution afterwards. After which you will have, a day which price does little to nothing. Whereas here, in this quarter, we had what? Manipulation. And here, what happened so far? We start getting, this lackluster price action, which is good to focus on. Like, whenever you see this happen, so you have manipulation here on the monthly cycle, price falls. What do you do afterwards? A rule that is set in stone, by me, Carter's theory is mine, is that when you have this happen, you want to drop lower to a lower time frame cycle to get the next move. That higher time frame quarter here, which is a part of the monthly cycle, will be more reactive on the lower time frame cycles due to the fact that we had this happen, prior to this week. Do you understand? So again, right here, you can see that price seems to be what? Price seems to be, low probability this week, right? And at times, you will not find the move that you want within the Forex market. You'll have to switch to the index futures market. So right now we are, predominantly focused on, three markets, which we're focused on the Forex market, the index futures market, and we're focused on the interest rate triads, which is the, interest rate markets, bonds and, the 10-year note and the 5-year note. So there's a sequence which, the markets will, play into, as I would say. And at times, right, even though you have the higher time frame manipulation here, right, and it happens here, it's very low probability to get it happening here, right? But you will find it on a lower time frame cycle. So here we have the monthly cycle. You will find it within either the weekly or the daily cycle. Here, if it doesn't happen here within the weekly cycle, or it can even happen here within the weekly cycle, you will find it in the index futures triad on the daily cycle. So the manipulation within the Forex market, and now because we don't want to get everyone confused, right? We're talking about the Forex market and we're comparing the Forex market to the index futures market, right? The higher time frame manipulation which occurs, within the Forex market, right? Because everything revolves around the US dollar, right? So when you have manipulation here, which is higher time frame cycle, then you will get a lower time frame cycles manipulation, in the upcoming higher time frame quarter, in the index futures triad, which we'll be looking at. So again, here, one last time, we had manipulation here. We're not ready for this yet, right? We had manipulation here, and this is Wednesday, the 12th of June, right? Here is Wednesday, the 12th of June, right? Where you can see that we had, price expanding higher into Thursday, right? here, right? Wednesday we had price expanded higher into Thursday. But what happened afterwards? It fell. Why did it fall? This is due to the fact that, of course, we had sequential SMT here. But here, we did have, like, you can't, not pay attention to this, right? We did have price fall, but look at this. Price fell below this low. Looking at the euro here, when price fell, it fell below this low. What happened here? Price did not fall below this low. It didn't. Right? And to make it a little bit clearer, we will add the NASDAQ right here. Okay, that's the wrong one. And we use the crosshairs. So here, we had price falling, right? Here we had price pull back and begin to consolidate. Due to the fact that we had the E-mini, NASDAQ, and the same thing happened for the S&P 500. We had this stuck in premium, right? This became mirrored, as we've said before, right? And the fact that it didn't even, go below this low, come, within this gap right here, which is, something else that we will discuss when we go to the other chart. This is what caused this expansion. And then also we had sequential SMT here, right? Here you can see that we have, candles that differentiate, as I would say. So NASDAQ, this is a up close candle. For the Great British Pound, that's a down close candle. So until you see a cracking correlation, which occurs here, and remember this low right here and we're going to look at that eventually, right? This low right here, which failed to take this low out, this was sequential SMT. This candle was the last candle down. And remember, when price was here, we expected a upward thrust. We expected, a price to pump right here. And this is why. So literally, right, due to the fact that here, the Great British Pound traded below this low right here. What is this? You already know what this is. That's sequential SMT, isn't it? What caused this? Like, which candle closed below this one? This was on a closure. Which one closed below this one? This one. This one which closed. What kind of candle is it? Is this a precision swing point? No, it's a precision candle. Why? When this was this one. This candle right here, which closed below this one, it's a precision candle. Why? The Great British Pound, the NASDAQ, or the Great British Pound, the S&P 500, or the Great British Pound and the Euro, they should always have, closures, if all of them should close the same. So if price is symmetrical, they should all have up close candles. If price is not symmetrical, what will happen? Price will usually reverse. Right. So here, what do you see? This candle for the Great British Pound is a down close. That candle for the E-mini is a up closed. That candle for the Euro is what? It is a up close. We're going to zoom into this and inspect it some more. This is something that I believe I hinted at before, but it's important. So the first thing to remember is we already have intermarket sequential SMT going on, right? The moment that we had this candle right here, right? This candle form, that was sequential SMT. Do you understand? Well, from we had this closure right here was sequential SMT, as I just said, but this candle is what set everything in stone. What is it? You already know what it is, right? It's a precision swing point. And remember that the 4-hour time frame is linked to what? It's linked to the monthly cycle. So within the monthly cycle, whenever you see a crackling correlation between candles, that's an indication of reversals. And it's the same thing for the if you compare the bond market to the Great British Pound or the bond market to the NASDAQ, every candle's closure should be symmetrical in regards to time, of course. So here, this candle formed. Here we have this one formed, precision swing point. But guess what now? What are you going to learn now? I think you should already know the name that this is going to get, right? This right here is an inter-market precision swing point. Did you get that? It's an intermarket precision swing point. So this candle right here, and we'll just take this off. This candle right here, right? And this candle right here causes price to reverse. Why isn't this? Yep. Right? Again, let me show you the candles so you're not confused. This is what caused the reversal. Do you see? Another thing to take into consideration here is that in between the euro and the Great British Pound, you see that the candle which causes, the formation of the fair value gap right here. So here we have, this candle having a gap in the euro. And we talked about this before, do you remember? Right? So this candle right here, right? The symmetry of gaps, in between the euro and the Great British Pound. For the euro, it would be this. For the euro, it would be this candle right here. Right? So this gap right here. But for the pound, it would be this gap right here. All of this is specific to what? All of this is specific to the monthly cycle, right? We're looking at 4 gaps and we're looking at 4-hour precision swing points. At the lows here, you can see that this candle right here had a gap for the Great British Pound, So focus on the Great British Pound right here, right? This candle has a gap inside. Look at the euro. There's no gap there. It's just a candle. Whenever you see, within a, cycle, like for example, or time frame, is allotted to the monthly cycle, you see two gaps within one asset class and just one gap within another asset class. So when price get to this level for the euro, it didn't expand anymore, right? This extra thrust right here, which created this gap, had to be immediately rebalanced, which is why we had the precision swing point right after it. And the same, goes for this, right? Here, where you see this gap being filled in the euro, so right here you see this candle filling this gap right here, then returning to the gap, trading below the 50%. Just wicking below the 50%, the bodies are almost at 50%, right? Here we have this gap inside. This is I'm trying to not make this one too long because we still haven't, talked about our analysis from Sunday, right? This gap is high probability. Why is it high probability? At the 50% of this gap right here, do you see it? This gap right here, 50%. Why is this gap important? It's just one gap to the downside before the formation of the precision swing point. This gap, right? There's a cracking correlation between gaps. This has one. This has two. The Great British Pound has two. This one has one. And most importantly, this has none. So here, this would become what? This candle right here. Because this candle is just a down close candle. These are gaps. This becomes a high probability order block, this candle. Also, there was what? There was sequential SMT here. We had a higher time frame, right? We had and this is usually the case whenever you have, for example, a NASDAQ in premium and you have, the Great British Pound or the euro in discount. This causes, a cracking correlation, which will, send price higher. And if you guys remember, right, and we're going to look at that very soon, we expected this. So we expected the NASDAQ to go higher, we expected the S&P 500 to go higher, we expected, basically everything to go higher. Because whenever I talk about the NASDAQ, then I'm talking about euro, the British pound as well, right? So here between these three assets, yes, there's a cracking correlation. This gap right here, there's two gaps here, there's one gap here, there's no gap here. If you look at the cursor again, see, at this time, if you look at the candles at this time, what is there? You can literally see the Great British Pound, has a gap which follows this candle, which is a gap. The euro just has a candle, which is what completed its fair value gap. And then you have the NASDAQ having an order block form. This is what you call a cracking correlation. This isn't a cracking correlation between highs and lows. You learned that already. This is a cracking correlation between PDRAs. right? And I wouldn't completely say just P arrays. It's basically just gaps, the formation of gaps, how much gaps form here. But whenever you see, price expanding, to the downside, within two assets and, they're closely correlated, there's one gap, a precision swing point forms right after that gap, but within the other asset, which is closely correlated to that one. So, for example, the Great British Pound against the Euro, we have its precision swing point forming after two gaps. Also here, right, and look at the Euro. Let's take the NASDAQ off for now. You look at the Euro, right, this single gap right here is high probability. And look, if you look at the time, well, not the time, if you look at, right, the gap right here, it's in the center, right? It is in the center. Also, you can use this gap, right, the candle which forms the gap right here, to, a lot transparent, pre-market discount. So this allows you to see through, the actual premium discount that's, already happening, so it gives you a, point to work with. It gives you more, visibility of price. This candle right here, you can see that if you draw these fibs here, and I want to do it like this, you can see that, and you wouldn't be looking at this until the price reaches into this gap, right? So we had this happen. The cracking correlation occurred when this candle right here, closed here, filled the gap, returned back to the 50% of the range, and the gap, there was a fair value gap within. And if you realize there are no fair value gaps here, the only fair value gap is right here, right? That's where the only fair value gap is. Price filled the fair value gap, rallied. Here, if you take this candle right here, you put the fibs on it, the price won't even be at this candle, because when this happened right here, so this pullback occurred here within this precision swing point. So we had this pullback occurring within this gap, right? Within this range of this candle, right? Not, touching or going near to the precision swing point, while as here, price pulled back into the precision swing point. And what's that? That's another cracking correlation. So do you understand? This and this right here is what? It's still, it's still basic. It's still just, of course, yes, these is why, the market turns around, but it's not everything, obviously. And I've been giving you new things over and over and over as we go along. And remember, we don't use hindsight here. And why is it that, you go so slow? Because I don't want you to be feeling as though you're feeling right now. Whereas, you're just bombarded with information. And, you don't know which one to use. But if you want to know which one to use, just, start backtesting and see what pops out at you the most. We will have more detailed, information, being given, of course. And we're not done for today. So yeah, if you need to get a drink, get a drink. So anyways, Here, price is within this gap. This gap, which is, the same as this one right here, was not reached right here. Price pulled back here within this fair value gap. And when this pullback was happening here, the euro was pulling back into this gap right here. So this gap right here would be of no importance, right? The second gap, the one which is the cause of the cracking correlation, due to the fact that there wasn't a second gap after this candle right here. And you must be looking at, so you don't get confused, these that you're comparing should be of the same broker. So you should be getting the data delivered from the same place. So again, let's do it again. Here, what happened? Once we had price, and this is, a easy way to get, for example, a day trade. We had a precision swing point here. We already had, a higher time frame sequential SMT. This gap would easily be filled due to the fact that price will, not just blow through this one right here and go to this candle right here, right? The British pound will expand. This right here will fill this gap, and you can see that it even went above it, right? While the British pound is trying to reach its gap. So a point in time, whereas it would be to take profit here, would be when the British pound, has traded into its gap right here. Right? Here would be just seen as a void, cake, knife can, butter knife will just cut through this. That price will just shoot through this like nothing and pay no respect. Also, you can see that here price was in what? Discount. Right here, price was in discount. From this high to this low, it's in discount. From this high to this low, when price was here pulling back, where was it? It was in premium. So we had mirrored premium and discount here, whereas we have, and this is just to show you that whenever you see these cracking correlation, I'm just saying this one last time before we move on this for too long, right? Whenever you see this cracking correlation, whereas you have, this candle right here form a fair value gap, but there's two fair value gaps here within another close to correlated class. You can use this candle's high and this candle's low for premium and discount. Here, you would just use this candle's fair value gap as a drawn liquidity, right? And as long as price is below this gap, you would automatically be in discount. And you can't be more discount than this. Also here we had what? Price pulling back into this precision swing point, right? We had price pulling back into this precision swing point. While here, price failed to do so here. So this in itself is a cracking correlation, right? Due to the fact that price did not get to here, but price was still, functioning within this candle right here. Here, we're going to look at what I call the debt stab, right? So first of all, you should understand and remember what I just said. Everything I just said was that what? For example, here we have the S&P 500, NASDAQ, and the T-bond futures. They should all, every candle should, be closing in the same direction, right? If this is an up-close candle, this should be an up-close candle. If this is a down-close candle, this should be a down-close candle. Crosshairs on. Here, we're going to, pay attention to this gap right here. This candle right here, what do you see? They're all up-closed. here, what happens? Right? And now we're looking at precision candles, which are, which usually forms more than precision swing points. Right? Here we have what? A down close candle for the E-mini S&P 500 and a up close candle for the NASDAQ. Right here, even though price is here, right? This is showing you that, price is getting ready to pull back. So what would you wait for after something like this? Do you just buy? No. And remember, we already saw this move. This wasn't, this isn't something that we're just looking at, right? This isn't hindsight. We talked about this. After this, you wait for another cracking correlation, such as what? You're going to wait for a sequential SMT to form. Here again, what do we have? Another cracking correlation again. So we have two precision candles here. Below this candle right here, there will be an immense amount of liquidity. Looking at the S&P 500. Right here, we had price fall below this low, rallied, failed to break above this low. Then here, we had what? Price fall below this low again. So once you see this happen, and remember that while price was here, we expected price to pull back within this range, the S&P 500. We talked about this. Never underlook or anything that I talk about. If I say that I want to see price pull back within this range, expect price to pull back within this range. Right? So price pull back here. Why didn't it go lower? Because there was this. The basics. Right? There was sequential SMT. Here. Right? So we had this low being taken out. Then we had this low being left. But what's really important right here is the fact that we have this candle right here, which is a precision candle. This low has an immense amount of liquidity below it. And the fact that price did not go below here, but we had this sequential SMT forming below this low. Right? And another thing is that, below a precision candle, at this low right here, you do not, this is a precision swing point, this is a precision candle, right? You don't want to use, this candle as a base of your sequential SMT, which is why you wait for this, right? You wait for the cracking correlation to occur below it and fill the rest of the gap. Here, price did not come below here, where we also had SMT fill, right? So you gotta pay attention to this candle right here. It's important. Why? This candle is up closed. This one is down closed. The query will be below these lows. The fact that we had sequential SMT below this low and not below this one shows you that price is bullish, which is what we expected. Here, and we will be going deeper into this now, is where we had this happen, right? So right here, where we had price pullback right here as well, is what we're looking at here with the US dollar index over here. So first of all here, what is this? Again, that's a precision swing point. We're looking at the daily cycle right here. There's so much models that's like being given to you right now, but maybe for some people it's like overloading your brain, but this is just insane. So the first thing is we expected price, above these highs right here. Looking at the S&P 500, this was a withdrawal liquidity, and it wasn't. Oh, and I don't know if it was, very confident, us expecting price to go above that high. Here you can see that. What is this? This is SMT right here, isn't it? Right? The same thing here. But why didn't we, why wouldn't we use this one? There's no precision swing point. Do you see? So a precision swing point completes a move like this, or, manipulation. That's like the final addition. That's like the, okay, let's go in. Right? So this right here is a model in itself. It is fractal. So the first thing is, and this is almost, I'd say, perfect. But here, what was this? We did have SMT here. It was sequential, right? You can see that it was, but this wasn't a precision swing point, right? Also, I'm, sure that this wasn't a news event. So whenever you see this happen, we have no news event as yet, right? And then we have, this final manipulation here, this precision swing point right here, which goes below this low, which was, already manipulated, but there was no precision swing point, so, we wouldn't be paying much attention to this. If you remember this rule, for stops. So basically here, right, you would use one standard deviation for your stop loss, as you already know. But due to the fact that if you look right here, right, this is the low, which is lower than this one. So you will use this low, which is the more prominent. So from this high to this low, here would be your stop loss, right? But you would basically, you want to focus on this right here, the 3 jabs, right? Where you have 1, 2, and then 3, right? That's what you would want to focus on, this one. So here we had a cracking correlation, which was not confirmed by a precision swing point, right? Being taken out by a precision swing point, and this causes sequential SMT. Do you understand? And even though, right, we're looking at this low compared to this one, right? And why is that? Because in the NASDAQ, this low right here, was taken out by this one, which is a precision swing point, right? This low is important, right? It's not the lowest low, but it's not the low, it's the time of the low. Do you see? So here, the NASDAQ's low, you can see it forms right here at around 2. It was around 2 on Tuesday. So 2 and Monday. So this was the London session. Here, right, we had this low formed due to London session. Then we had price manipulate, gave us a precision swing point right here. If you look to the left of the precision swing point, what's there? A precision candle. So that wasn't a swing point, that was a candle, precision candle. When you have a precision candle next to a precision swing point, that's high probability that price is going to reverse. Then we have, the sequential SMT there as well. So price ran below this low right here, but within the dollar index, and then you can see we have intermarket sequence SMT, whereas during, and then this is like the icing on the cake, right? During the New York session, price failed to break above this high, which is, London's high. So this is how, AMD occurs. And AMD can occur, right? It can either start in Q1, where we could have A in Q1, or you could have A in the London session. Here you can see that the London session was, consolidating. And the only time when, M is confirmed, is when? Whenever we have intermarket sequential SMT and sequential SMT. Another thing to, pay attention to is that if now, and now we're going to go, right, this candle right here, pay attention, it's a precision swing point. This is a precision swing point in the NASDAQ, precision swing point in the S&P 500, precision candle in the US dollar index. If you're someone and, you desire to trade the S&P 500 or the NASDAQ, you want to keep close tabs on it. You don't want to be looking at too much information. This is what you'll do. If you are a day trader, this is what you'll focus on. The 15-minute time frame. The 15-minute time frame. Right? And you don't just use the sequential SMT between the NASDAQ and the S&P 500. You compare it to the US dollar index and see if there is an inter-market sequential SMT. Do you understand? So the dollar index fails to take liquidity. NASDAQ did it. The S&P 500 did it. And afterwards, what happened? We had a cracking correlation right here, literally the low, right here, the low of the day right here, being a precision swing point. And this candle right here would form with this fair value gap after we had this cracking correlation right here, which was also a sequential SMT between the US dollar and the Great British Pound and the Euro. But now we're just focusing on this right here. So this is a precision candle. So now we have another intermarket cracking correlation between the precision candle and the precision swing point. It's not that it's just this is not even a swing point. It's a candle. This is not a swing point. This is literally the candle that's lower than the one to the left and the one to the right. It happens when? After we have intermarket sequential SMT and sequential SMT at the same time. Does price go here? Does price trade below the true open? It did. It traded below the true open. Where is the true open? It's right here. 12 o'clock midnight. And I'll put it right here as well for the 12 o'clock midnight. Also, you'll see something else that's cool looking. What's the high probability true open day? Can you tell me? Like, how do you know? Okay, we'll go get to it. 12 o'clock midnight. This is the open. Right? So you can see that everything happened, above. It should be above the candles. The precision swing point, the precision candle should be above the true open if it price is bearish. And you only pay attention to the true open if you have sequential SMT, and you can, you add intermarket sequential SMT for extra what? Extra confirmation. There's nothing that's like there like this ever. We're not done here. Right? We're not done yet. Soon. This is the perfect setup. This is why I told you guys to expect the drawn liquidity, because I wanted you guys to go into your charts and see what you'll find. Right? And that's how you'll learn. Here, look at this candle. This is the 12 o'clock candle. Is it up closed or down closed? When did it close? It opened here, then it closed down. Right? It closed down. This one. And what would it do? It was an up close candle. There is nothing in price that is random. There's nothing in price that's random. Do you understand that? This is high probability. That's another current correlation. Do you understand? This one should have you studying for like 2 weeks, man. Right? So that's a cracking correlation. That's a cracking correlation. Here we had this. That's a cracking correlation. Price traded below this. The formation of the precision swing point confirmed the actual sequential SMT. Price rallied. Price rallied. Here, intermarket sequential SMT. There was also sequential SMT between the US dollar index and, the Great British Pound. Well, there was sequential SMT within the Forex market. Right? And here, what do we have? And when did this happen? In the fair value gap. See? At price rally in the fair value gap, formed this candle, broke down above the true open. That's important. It's above the true open. Do you see how powerful this information is? Do you understand? It's crazy. It's insane, actually. And remember that we talked about these things before it happened. And I always say that because, right? This is what we, usually actually taught and on YouTube, but without, the extra stuff. So that's basically the idea. But how do you actually get the accuracy? How do you actually know when it's going to turn around? This here. In unsymmetrical lows being ran out. So these lows are asymmetrical, being ran out. You must have a news event here during New York. Even if it's here, it doesn't matter at what time the news event happened, right? If it happened here and there's, you didn't have a precision swing point formed, then you wait until the precision swing point formed, because sometimes the injected liquidity is delayed. So there'll be times at 8:30 they will release news, but the market doesn't manipulate until when? 9:30, 9:45. It literally waits a quarter, right, to manipulate at times. Or if the manipulation occurred before, and remember, the precision swing point must be there, and that's why it's a precision swing point. It gives you precision. Listen, it's not, a fluke. It's not a, what do I call it? It is not a mistake. It's not random that you keep having precision swing points forming the lower the week, the higher the week, the lower the day, the higher the day, the lower the session, and the higher the session. The lower the 90-minute cycle, the higher the 90-minute cycle. You have precision swing points. You couldn't see this unless you compare each, asset classes, each asset class. Then what? You have intermarket precision swing points. You have intermarket precision candles. Yes, everything is connected. Do you understand? The only reason why price turns around is because there is not symmetry between certain asset classes. Study this. Now you should be able to be, catching the higher low today, or getting close to it, or after. It's accurate. You don't need 100% accuracy. How look at this, right? How much did price move from where did we? I believe we did the live here. We expected higher prices, so the live occurred here. Then we had the true open, right? Then price fell below the true open, created sequential SMT, formed a precision swing point, right? After intermarket sequential SMT and sequential SMT then expanded higher, right below it, right? It just dropped below the true open and went up. Do you think that's random? Do you really think that's random? Do you really think that? Oh, he just got lucky again. He just got lucky this week again. Do you really think so? Soon we will be like, pulling out the big guns. So be sure to study this. I hope that you found something useful from this. And, we will talk this Sunday. You have a lot of studying to do. Cheers.